Hello, chart watchers, and welcome to this Thursday, August 8th, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time, welcome to the show. And for our regulars, welcome back. Taking a look at the market action today, we are seeing more strength. Dow Jones Industrial Average currently up 278 points. The S&P 500 up 42. The NASDAQ up 137 points. And the Russell 2000 regaining some strength here, up almost 27 points today. Part of the reason that the stocks are doing so well, money is rotating out of treasuries. You can see the 10-year treasury yield up about 8 basis points back to 1.76%. Of course, when the yield is going up, it means treasury prices are going down, and those proceeds are then available to move over into equities. Volatility index continues to move back down after the huge spike we saw last week and into the earlier part of this week. We can see it is backing back off again. We were up near 25 earlier this week, now back down below 18. Anytime we get back into a downtrending VIX, that is generally very positive for equities. Technology leading to the upside today, and what's really encouraging is that outside of materials, when you look at the 5 top groups today, technology, consumer discretionary, financials, and industrials, 4 of the 5 aggressive sectors are leading this move back to the upside. That was one of the things I wanted to look for. So far, so good. Travel and tourism having a really good day today. Booking Holdings came out with their earnings after the bell last night, came in well ahead of estimates, and that is the reason for travel and tourism doing well. Software stocks also, after taking a pretty good beating at the end of July, early August, rallying back. This has been one of the best areas of the market over the past couple of years, and they're looking to regain their leadership and strength. Couple of names having big days today. Roku reported after the bell last night. Another huge report. The stock has been one of the best performers over the course of the last 8-9 months, and continued that today with a huge rally after earnings. And then, of course, Advanced Micro Devices having a very strong day as well. Not yet breaking out, but up more than 14% on the session after a pretty rough week to 10 days. AMD getting a lot of those losses back in one day. All right, Erin, pretty solid recovery so far. Last couple of days, even yesterday, we didn't finish up that much, but after being down 2% at the open, it felt pretty good to have that big recovery. And now we're seeing a little follow through today. Looks pretty good.
Yep, absolutely. Before I wrote my midweek review, I did check out, what the market had done most of yesterday, and just looking at the VIX, looking at breadth, I was looking for this. I was looking for a bit of a bounce here. Now, whether it'll turn into something that'll get us to new all-time highs, that I'm not so certain of, but I definitely was looking for this kind of relief bounce.
Yeah, well, none of the indices have yet moved back above where they were at the end of last week. Remember, we had that big gap down on Monday. So essentially, we're filling the gap right now. And on the chart, you can see the NASDAQ's the only one that has gotten back up there. The S&P's almost there. The Dow's got a little bit of work to do, and the Russell's got a little bit of work to do. So overall, I think the action's been good, but we got a lot more work to do. And we have got just the right person here to explain everything to everyone today. John Murphy, always a pleasure to have you on the show. How are you doing?
I'm doing great, Tom. Thanks for inviting me. It's always a pleasure to be back.
Well, it's always a pleasure to hear what you're thinking about the market. And I'm sure everybody listening in is sitting on the edge of their seats wondering what you think of all this selling and now the recovery. Do you want to give anybody a sneak preview to what you're going to talk about? I mean, are you bullish now, or are you a little cautious?
Well, I will say this just to add to what you and Erin just said. What's also encouraging is that a lot of these indexes, like the Dow, bounced off their 200-day moving average yesterday. Mm-hmm. A number of sectors did as well. So that's very encouraging. I must admit that is encouraging. But I am a little still concerned. When you take a longer-term look at things, I still think that our market and some of these global markets are still somewhat vulnerable. I still have some concerns about the long-term picture, although the short-term picture is improving. I'm kind of looking for choppy markets over the next few months. But so some of the charts I'll be showing you in a little bit kind of make that point that some of the longer-term things still concern me a little bit.
All right. Well, I have one question for you, and you can think about this a little bit. Maybe we'll have time to talk about it during your presentation. But Carl Swenlin was in yesterday, And we talked a little bit about Dow Theory and the fact that, you know, we've seen the breakout. We saw the Dow Jones Industrial Average move to an all-time high, but the transports have not confirmed. And historically, through this bull market, when we've gotten the transports to confirm, we've had huge run-ups in the market back in 2013 and again in 2017. So I'm just wondering if you have any thoughts about that, but I'm going to save that and let everybody wait for that, because I'm really anxious to see what you think about the transports not really participating here as the all-time highs were hit on some of the major indices. But hang in there. We're going to get back to you here in about 8 or 9 minutes, and everybody's going to want to stick around for your presentation. All right, Erin, what do we got?
All right, upcoming schedule. We had a great week, but we've got an even better week. Well, a great week next week as well. Dr. Alexander Elder will be in on Wednesday, and Julius DeKempener, Mr. RRG, will join us on Thursday. And then, Tom, you have a workshop that's going to be coming up August 20th. So I'll be interested to hear what your topic will be.
I already know what it's going to be. It's going to be building a portfolio.
Awesome. All right. Talking technically, Greg Schnell. Today, we're going to look at area charts. We have got, of course, John Murphy, who we just mentioned. We're going to talk a lot to him about his thoughts. 10 and 10, our first symbol will be Grayscale Bitcoin Trust, GBTC. So if you want to go take a look at that beforehand, go right ahead. But let's go ahead and get started with technical news and headlines.
Yeah, we only had a couple of economic reports out today. You can see initial jobless claims came in better than expected. So again, another solid economic report, not really supporting those who are looking for a recession ahead. I really don't believe that's going to happen. I guess time will tell. June wholesale inventories did come in a little less than expected. They were flat, and the market was expecting 0.2% increase. We did not see that. As far as the bond market's reaction, I'll tell you, I just think that the bond market got very, very overbought. It was just too much of money rotating into treasuries. I don't know that we've hit a bottom, but I do think that we just kind of got to a point where it was time for some profit taking in treasuries. That generates not only proceeds, which can then be used to buy into the equity market, but it also puts in a bottom on the yield. We saw that. We got down just below 1.60% yesterday, and already a 10% move back up from 1.60 to 1.76, but there's still a lot to go here. As far as earnings reports, let's bring those up. You can see those on your screen. I'm going to go ahead and jump right into a couple of the reports that I think are just off the charts good. And one was Roku. I mentioned this one earlier. I think Roku has been just a tremendous performer. You can see the stock up right now, more than 20% on the day. They came in, they just blew away their estimates, the top line and bottom line. They raised their revenue guidance going forward. It was a super report. Another one that did the same, Mercado Libre, MELI, huge move to the upside, making this breakout. Look at the relative strength moving to new 52-week highs relative to its peers, and also relative to the S&P 500. I mentioned I'm going to do a workshop on Tuesday about building a portfolio. Well, this is kind of what you want to look for. You want to look for stocks that are showing tremendous relative strength. I actually pulled up, this is a model portfolio, and I established this back in November of last year. Here are the 10 stocks in it. They're equal weighted, held 3 months, and then they simply get pulled out and go with another 10 stocks. Not a bad day today for the model portfolio. Huge, all 10 stocks right now up over 1%. Roku, AMD, and Mercado Libre all up more than double digits. That tends to lead to a significant outperformance versus the S&P 500. For anybody who is interested in that, just want to point out that in my article today, if you go down under sector industry, the sector industry watch here, I talked a little bit about Roku. And mentioned here that I'm going to be having a webinar on Monday with John Hopkins, and I'm going to talk about these portfolios and how I put them together. If that interests you, go into my article, click there, and join us on Monday. All right, as far as the scooter mover, well, I can tell you that the scooter mover today, the one I really wanted to focus on was, and I didn't save it to the right folder here, but it is eBay. All right, let me go ahead and pull eBay up here and let's take a look at the chart. And I'll tell you what I liked about it very quickly. You can see that eBay trying to make a breakout here. It did hold price support where it had broken out from. So that's point number one I wanted to make. And then also, if you look at eBay versus the S&P 500, it is now breaking out to a new 52-week high. And look at its peers, absolutely on fire versus the S&P 500. So you've got a good group, and now you've got a good stock. A breakout above 42 on eBay would be absolutely awesome. And for that reason, it is my scooter mover of the day. Next up is Greg Schnell talking about area charts on Talking Technically. We'll be right back.
I want to talk about how to set up area charts as an indicator rather than a line chart. And the reason for that is that way when you quickly look at your indicator, you can tell that it's something specific by formatting it differently. So in this particular case, I've used relative strength, so the Amazon compared to the SPX. And the problem is it's coming out in a really dark purple color and maybe not that beautiful. So what I like to do in that case is just change the opacity, and you can set it down to a different lower level, like perhaps 0.4, and that gives it a nice shading. And then what I like to use is a simple moving average of 1 and purple, and what that does is it puts that fine line on the top of it to give it a little more detail.
All right, we are back. I have some upgrades and downgrades for you. I'm going to start off with Disney. Disney was upgraded, and I know we talked about Disney quite a bit yesterday, so I thought we would revisit this on the upgrade. I am looking at, of course, we had the big gap up, and then I was looking at a rising bottoms trend line. I'm going to move this and actually connect it from this bottom right there. Oops, let's get that back. And you can see that we had broken down below that. Now, the question is, we lost the 20 and the 50-day EMAs, but it is making a nice rebound today on the upgrade. And let's look at the support and resistance levels. That would be your support, of course, at that gap support, the top of that gap that we had back in April. And then, of course, your overhead resistance is up here at about 147. So, this could be a nice area right here, and I'm going to get that trend line here so you can see. This could be a nice area for some support right here at 130 if we are going to see Disney move down a bit more. So that's one that I would watch for. The PMO is still in decline, so we did get this upgrade, and I know, Tom, you had said to be a little bit careful with this one, and I would have to agree even on that upgrade. Next up will be Caterpillar, which was downgraded today. And Caterpillar is actually sitting right on some support. It just barely got down there, and then it has bounced back up. I think that is encouraging for sure, but I don't like the looks of momentum. We are seeing it starting to slow down a little tiny bit. We're getting a tiny bit of deceleration, and we are getting into that oversold area for the PMO. So this could be a really nice area for it to turn back around. But with a neutral upgrade, I wouldn't expect too much out of this. A neutral downgrade. We'll have to see what investors think about that downgrade. You've got quite a ways to go before you're looking at overhead resistance. I would say you're really going to be watching that 20-day EMA as your first level of overhead resistance. And that's all I have for some upgrades and downgrades. And there is that list. And you can take a look at them later. I do get these from briefing.com. So if you wanted to see all of the ones that are there, that's where you would go. All right, we will be right back after this commercial with John Murphy, so stay tuned.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have chart school and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.
Right. We are back, and we do have our special guest here, John Murphy, author of several books and really our head technician here at StockCharts.com. Welcome, John, and I can't wait to hear what you have to say. So let's get started.
Thank you very much, Erin. I would like to actually today at least start with putting things in a longer-term perspective. I know we're all focused on the very short term, and also with a global spin. You know, everyone's talking about global weakness and the effect it might be having on the U.S. market. So I wrote a message last Saturday. You have it right up there. S&P still in record territory, but looking vulnerable. Okay, weekly indicators show some loss of upside momentum. What I'm really focused on is, yes, the U.S. market was in record highs. It still is very close to it. But when you look around the world looks a lot weaker, and that really concerns me a little bit because it's very hard for the U.S. to carry the burden all by itself. So if we go to the charts, you'll see what I'm actually talking about. Just the first chart here, remember this is last Saturday. It's a weekly chart. I think when I really want to get a sense of real trends, I generally go to weekly or monthly charts. This is the S&P 500 now. You can see very clearly in the lower box there, it hit a record high, and that's all well and good. But if you draw a trend line, and I've seen other people's on our site showing the same thing, if you draw a trend line over the highs of last year, we're sitting right on that trend line. So right off the bat, that's it means we're up against some resistance. So that's basically all I'm saying here. By the way, the blue and the red line there, we did slip below the 50-day moving 10-week moving average this week. We held at the red line, which is a very good sign. But anyway, the whole point of this is just to show that the S&P looked a little bit vulnerable from a technical standpoint going into this week. And if you look at the two indicators on the top there, the top line is the 9-week relative strength index. And I was simply trying to make the case that when you see that blue arrow, that shows that the high that was set in July is lower than the high that was set in the spring. And as we all know, that is a negative divergence. Again, warning that this move into record highs is a little suspicious and maybe not as strong as it looks. And then finally, if you just move down to the middle indicator there, that's the weekly MACD lines. They don't look that bad, but if you look at the histogram, those green bars there, I like to look at those. Those actually measure the distance or the spread between the other two lines, and you'll notice a negative divergence there as well. You know what I'm talking about. You see that little falling trend line. So when I look at the S&P up against that trend line, loss of upside momentum in some of those indicators indicates to me that the market was vulnerable for some type of a pullback, and we appear to be getting that now. But that's the U.S. by itself. What really concerns me is the next two charts. We can move down to chart 2. This is the all country iShare, MSCI All Country World Index iShares. That's the blue bar. Now this includes all the markets in the world. It includes the U.S. In fact, the U.S. accounts for a little over half of the global picture. The rest of it is composed of foreign, developed, and emerging markets. This gives you a very different picture. It shows that the recent high that we have this summer is just a retest of the highs from last September. The reason it looks weaker than the prior chart is because it includes foreign stocks, which have been weaker. And this raises a little bit of a little more concern for me because it just shows that we are up against the highs of last year. The indicators on the top also show overbought and some negative divergences, which indicates to me once again that the global picture is also due for some type of a pullback, and it's also looking somewhat vulnerable. Now we did get a pullback this week. We did hold above. We actually touched that red line there, which is the 40-week moving average, and we have bounced off it. So that's all well and good, but I'm still a little bit concerned that I don't think that we've seen enough over the last couple of days to suggest that this thing is ready to move into new highs. I think we still have a lot of intermediate term problems to deal with. And I wouldn't be surprised if we just backed and filled for the next couple of months. But that's this chart. This is the chart that includes the U.S. Now let's look at what's happening to the rest of the world without the U.S. And this paints a very, very different picture. This is once again, the MSCI All Country World Index ex-US. This is what the rest of the world is doing outside of the US, and it's not a very strong picture. You can see, and this is, by the way, includes developed and emerging markets. You can see it hit a record high at the beginning of 2018 along with us. We sold off during 2018, but you'll notice that the rally that we've had since the end of last year has only retraced 62%, which, you know, we always measure these Fibonacci retracements. And as we all know, the third one on the top there, the 62% retracement, that is usually the key one. And you can see that this thing just rallied right up to the 62% level, where also a test of the highs from late last year, where that blue arrow is. And again, it weakened. Now we over this last week, we retested those lows, and we're bouncing a little bit today. But this worries me a little bit because, yes, we know the U.S. stock market is the strongest stock market in the world, but it can't do it by itself. And, you know, the concept of breadth, you know, we talk about breadth when we talk about breadth in the U.S. market, the advanced decline line, for example. You know, in a bull market, we need to see more stocks rising than falling. Well, there's such a thing as global breadth also. When we have one market like the U.S. market, even though it is it is the biggest market in the world, even though we see that hitting a new high, when we look around the rest of the world isn't following, and I would refer to this as a negative divergence. We have one market hitting a new high and nobody else is doing that. So global breadth to me isn't as strong as I would like it to be. This worries me a little bit. It's one thing to have foreign stocks not rising less fast than us, let's put it that, because we've all been rising. But it's one thing to have them start to fall, and we've seen that in a lot of these markets. We've seen Asian markets really take a hit this week. Emerging markets have been very weak, led by China. We're seeing weakness in Europe. Everywhere else around the world, we're seeing weakness, and that worries me. It worries me if the rest of the world is weakening, or if some of these markets start to go into recession. Europe, for example, very close to that. It makes me worry that sooner or later this is going to begin to affect our market. We saw a little bit of that this week. So this is one of the things that has me a little bit concerned, that the longer range picture for the global market and for the U.S. market isn't as strong as I would like it to be. Now, do you have any questions on that, Erin? Can I just move on? Or?
I believe we're good in the chat room. Good.
Okay, so I have, speaking of breadth, I want to move on to one more message, which is one that I wrote on Tuesday, I believe it is. I think it's August, not that one. Yeah, this one. Same basic concept, slightly different spin to it. I wrote this on Tuesday. Stock market needs broader sector participation. 6 market sectors have yet to hit a new high. First of all, there were 11 market sectors, okay. 6 of them have not hit a new high. 5 of them have, and of the 5 that have, 3 of them are defensive sectors. We have REITs, we have utilities, and we have consumer staples. They have been the strongest, they have been among the strongest sectors in the stock market. And as you know, as we all know, those are defensive sectors, and it's not normally, in a bull market, you want to see economically sensitive sectors leading. You don't want to see these kinds of group leading on the upside. Now, we know why that's happening, because these are dividend-paying stocks. They're bond proxies. So because we had a collapse in bond yields all over the world and in treasury bond yields, that has pushed bond prices sharply higher. And of course, that has pushed money into these dividend-paying stocks in a search for yield. We understand why that's happening, but still, it's very, very unusual, especially in late cycle work. When you see money flowing into REITs, utilities, and consumer staples, defensive stocks, that is often very symptomatic of late cycle activity. It's not the kind of activity you want to see in a very, very strong bull market. So having said that, let me move on to the 2 other sectors that have hit new highs. There are two other sectors that have hit new highs. No surprise here. One is the technology index. This is the XLK. You can see it clearly hitting a new high. And we've had a pullback over the last week. And you can see we're testing the January highs. I just nothing too important going on there. By the way, that little green line that I drew there showing that arrow, you can see that we have bounced off that. So that normally a previous peak like that does act as a support level. So that's good news. So there's no serious damage being done in the technology sector. But the main point here was simply to show this was one of the few sectors hitting a new high. Now, if we move down to the second one, here's another economically sensitive group that has done very well, also hitting a new high. So this is good. This is good for the market when technology and discretionary stocks are in the lead. You can see that I wrote this red circle, put that red circle in when we slipped under that green line. We're back above it today, so that's very good news. Interestingly, by the way, just as long as we have consumer discretionary in front of us, I've been following the groups within this sector over the last week, and if you look at what's been leading it, it's housing stocks, home building stocks. If you look at within this group, and that makes perfect sense also because with bond yields plunging, this is very, very good for the housing industry, very good for home building. Within this group, we're seeing weakness in retail stocks for obvious reasons, even auto stocks to a certain extent. But the real leadership over the last couple of weeks, over the last month, is coming from home building stocks, which are benefiting from falling mortgage rates. But these aren't the big stories. The real stories are the next few charts. So that was just a little bit of a prelude. I'm going to show you now the sectors that have yet to hit new highs. Now remember, this was written a couple of days ago, so markets are bouncing a little bit here. We're going to start with communicate. These are sort of done in order of relative strength or relative weakness, starting with the strongest one. This simply shows the communication services select spider, XLC, which is one of the newer indexes. And you can see that during July, when we ran up, looked like we were about to hit a new high, we backed off pretty sharply. It was just in the process of testing last year's highs, by the way. Maybe that's just purely coincidence. So the highs of this July are testing the highs of last July. Maybe that's a seasonal thing. I don't know. I was simply making the case, though, that here's a sector that failed a test of a recent high. We have pulled back a little bit, nothing too serious, but it just concerns me. Whenever I see a group that is pulling back from a record high, concerns me a little bit. Move down to the next chart. We see essentially the same thing. This is the industrials. There you go. You can see that last little, I like drawing circles, obviously. That last red circle there, this was the high that was formed again during July. And if you look back, this is just basic, simple chart analysis, nothing fancy here. You can see that we have reached this level twice before, this spring during April, and again last September, October. So is it a warning signal? Maybe not, but it's just a sign that here's another group that even though the S&P and hitting a new high, record highs, here's a very economically sensitive group that failed to hit a new high. By the way, Tom, you mentioned transportation stocks before. I don't know, it doesn't sound right, but transportation stocks are included in the industrial spider. And I pointed out recently that weakness in the transportation group has been one of the things pulling this down. But here again, no serious damage being done. You can see we've come down to remember, this is 2 days old. We come down to the 200-day moving average, and we're bouncing off it very nicely. So there's no serious damage being done here. I'm just a little bit concerned about the inability of this particular spider and some of the others to hit record highs. If you move down, we're going to see essentially the same thing. Move to the next chart. Here's healthcare. Same thing. We moved up the third red circle here. It's the same thing over and over again. You can simply see that. Don't leave it just yet, Erin.
Okay.
Again, circle. You can just simply see that we're up against the old highs that were formed last year. Pulling back, nothing too serious. We did slip a little bit below the 200-day, but we're back above it today. So nothing serious. I'm just a little bit concerned about the inability to hit new highs. And if we keep going, Erin, we'll see the same chart here again. Materials, XLB. Once again, you can see that we're up against that trend line there. Those are the highs that we hit last September. We pulled back a little bit, nothing too serious. but still inability to hit new highs. This particular index did also bounce off its 200-day moving average yesterday. One thing about the materials, and I think I've mentioned this in a couple of my notes over the last, yesterday, for example, or let's say over the last week, materials have been one of the, in fact, yesterday materials were the strongest sector in the market. That may not seem to make a lot of sense, but if you look beneath the surface a little bit, the group that's been leading materials higher are gold mining stocks. And as you know, gold has hit a 6-year high. It's trading over $1,500 an ounce for the first time in 6 years. Gold mining stocks, I read in the paper today, they're up something like 40% in the last 3 months. I mean, that's incredible. So money has been pouring into gold, and that is what has been supporting, not necessarily today, but that's what has been supporting the materials. And at the same time, we're seeing money coming out of copper stocks, steel stocks, aluminum stocks. Copper, for example, hit a new low this last week. So we're seeing money flowing into gold stocks, coming out of industrial metals. So that's not a sign of strength, actually. Though it helps the materials, it's actually a sign, in my view, it's a sign of caution. Anyway,
Hey, John.
Enough of that.
Hey, John.
Yeah.
There was a question in the room. You were talking about gold, and the question in the room was, can you explain the recent correlation with dollar and gold? Because dollar's been going up for the last couple of months, although we've pulled back recently, and gold has been going up for the last couple of months. Normally they move opposite one another. So do you have thoughts on that?
Tom, about a month or two ago, I was on this very same show, and we discussed the intermarket influences that were very bullish for gold. One of them we always talk about is the dollar. One of it's probably the best known ones. But the other one, which maybe is even more important, is interest rates. Falling interest rates are very, very bullish for the price of gold because gold does not pay interest and it does not pay dividends. So when you have interest rates falling, that makes gold a lot more attractive. And as you know, gold yields have been plunging all over the world. I think that's what's pushing gold higher. And the reason the dollar is so strong is because everybody else's currencies are collapsing. We're seeing people lowering interest rates in Asia. We had 3 of them just this last week. We saw China on Monday. The ECB is about to lower interest rates. So it's a race to the bottom. So whenever they lower their interest rates, there's a currency war going on. They're lowering their currencies. And when you look at gold in foreign currency terms, it looks very strong. So yes, it is a little unusual, to answer your question, to see gold going up at the same time as the dollar. But if you look at the reasons why, it makes sense, because everyone else is easing, and when they're easing, that's keeping the dollar artificially high. But I think what's really driving gold higher is the plunge in global interest rates.
Okay, awesome.
Okay, Erin, you still there?
Of course.
Okay, let's go to the next one. These are all showing the same thing. I guess I should apologize for that. But these are the financial stocks. You can see, once again, up against the old highs, the red circles, backing off. Again, nothing serious going on here to the downside. By the way, financials also, just to update this verbally, also bounced off their 200-day moving average yesterday. I've been very concerned about weakness in the financials, banks in particular. But with the yields climbing today, this group, of all the groups that we've looked at, gets hurt the most by falling interest rates. Bond yields are very negative for financial stocks and bank stocks in particular. So this group, I just wanted to make the point that it has pulled back from that all-time high. So this is another group that has yet to hit a new high. They may very well do so at some point in the future, but they haven't yet. We did come down yesterday. We bounced off that 200-day moving average. In fact, financials are one of today's strongest sectors, and that is because of the bounce in yield. So all these things are correlated. And then we'll just move down to the last one. I guess I'll just mention this. It's not really part of this story, but energy stocks, as you can see, this is by far, this is the XLE. We're using all of the spiders here. This is by far the weakest sector of the stock market. We hit new lows just this week. And of course, that's tied to the price of oil. Oil is at its lowest level since the beginning of the year. Oil has been plunging recently. It was down another 5% yesterday. And herein, by the way, I'll just mention this last point before I leave these charts, just to make a case. This is also tied, in my view, the fact that commodity prices have been so weak. I'm not talking about gold. That's a whole different thing. the price of oil, the price of copper. Well, those are the two most important ones, have been so weak. That is anti-inflationary. And that's one of them. I've shown charts before that if you take the price of oil or the price of copper and put them up against interest rates, they're very, very highly correlated. So falling bond yields are symptomatic not just of a lower global growth, but lower global inflation. And that's what we're seeing here. So now I do want to correct one thing. I've been hearing on CNBC over the last few days that rising gold prices are a harbinger of inflation. That is absolutely not true. Most commodities are falling sharply. Gold prices is the only one going up. It has nothing to do with inflation. It's simply a flight to a haven currency, not a currency, but a haven of gold at a time when global yields are plunging all over the world and people are beginning to worry about the global growth. So gold is not going up because of inflation. It's a whole different thing going on. In fact, it's just the opposite. It's going up because of a little deflation creeping in. So I think that's enough of my charts, Tom and Erin. I think I'll turn it over to you at this point. If you want to ask any questions or look at anything else, it's up to you.
Yeah, I have a question on that last comment you made. I mean, we just had the Federal Reserve come out and they stated that, they were cutting a quarter point, but they really didn't give the market any guidance as to what they were going to do in the future. And of course, we're seeing central bankers around the globe that are quite dovish, and the U.S. is now being viewed as not so dovish. And so I guess my question, when you see energy charts going down or prices going down, and you see copper prices going down, and, we look at this potentially disinflationary environment, and even the Feds acknowledge that. Do you think that the Fed should continue cutting?
I don't think they have any choice, Tom. By the way, come back. You mentioned the dollar before and gold. This is the real impact of the rising dollar. You look at when the rising dollar goes up, that is normally bearish for commodity prices. We are seeing it here. We're seeing it here in copper. It's just not gold because gold is in a whole different area. I don't think the Fed has any choice, Tom. I've seen things now that the betting is now they're going to be under 2% by the end of the year. So I don't think the Fed has too much choice here. They're being pulled lower by global forces. I don't think they really have too much of a choice. I think they're going to have to get a lot more aggressive, especially with all of the pressure coming from the White House for a weaker dollar. The only way you're going to weaken the dollar is to continue to lower interest rates. And let me just finish with this one point, Tom. It bothers me a little bit. I know I've written about this. I keep reading the reason central bankers around the world are getting so dovish at this point is because rates are so low at this point. They're historically so low that they don't have any ammunition left when the next recession hits. So their strategy is to get aggressive now in order to prevent the recession. Well, you can't prevent the recession. You can only postpone it. And my feeling is, yes, that may help, but what are they going to do when the next recession hits? When rates are going to be 0%, 1%, what ammunition do the central bankers have when the next recession finally hits? And that's the thing that really worries me.
All right. Well, when that question comes up, I'm going to be looking and checking out your market message to find out what the answer is. I always look to you, John. When I have questions I can't answer, I look to your market message.
Really? That's why I read yours in the morning. I get my ideas from you.
Checks in the mail. Appreciate that. All right. Well, I got another question here for you. We talked a little bit earlier about the transportation stock.
Yeah, Tom, I tell you, can you click on this message here? Because I have a transportation stock in transportation. Can you do that?
Yes, let's do it.
Okay, going further down to the bottom of the chart, you'll see a transportation index in there. Where it is? It's the last one right there. Transports. There you go. I showed that yesterday. So your question was the divergence between the Dow Industrials. This is another thing that worries me when I look at the longer term picture. The Dow Industrials, we know they hit new highs recently. Historically, that traditional Dow theory, in a good, strong bull market, the industrials and the transports should be moving up together. And as you can see, and this only goes back, if you went back even another year, you'd see this looks even worse. The disparity is really very, very disturbing. The point of this chart, by the way, this was done late yesterday, was to show that The transports had fallen under their 200-day moving average, but we were still above support. Last time I looked, I think they're back above that moving average today. Transports are rallying very nicely today, but still there is an extremely wide divergence here between the industrials and the transportation stocks. This is another thing that worries me a little bit. And by the way, just to throw one more wrinkle into that, if you throw the utilities into it, utilities have been the strongest of the three. That is a defensive. So not only are the transports underperforming the industrials, but the utility stocks, which are defensive, are outperforming both of them. So when you put these together, it doesn't inspire a lot of confidence in the longer range picture for the stock market, and that does concern me a little bit. But the fact that we were able to, the fact that I did write last night that even though they were looking a little shaky here, it was very important that they stay above that early June low, and they appear to be doing that. Small caps, by the way, if you want to move up to the chart just above it, you see small caps, exact same thing. This is another thing that worries me very much. Small caps have been underperforming by a wide margin under the 200-day moving average, but still above the June low. They're also rallying quite strongly today. So even though they're very weak on a relative basis, and that does concern me quite a bit, in a really strong market, the small cap should participate. We did manage to hold above support, and we are rallying again today. So maybe there's some good news on that. And then I'll beg your indulgence, Tom, to just go to one more chart just above that. And this is another one that's a little more, maybe a little more critical. I mentioned the fact that bank stocks usually get hurt by falling yields. You can see bank stocks have also done quite badly under the 200-day. But I also pointed out last night that they're also sitting right on chart support. This is a very critical spot for this chart. The good news is that banks are rallying very strongly today on the big jump in bond yields. So the good news is that banks, small caps, and transports, which have been showing relative weakness, are all bouncing off some very key support levels today. So maybe there's some good news in that.
All right, I want to go over a chart if you don't mind, and I'm going to just pull it up here and show you and get your thoughts on this, because I think this is kind of gets it to the heart of the poll question today, which is whether or not our audience believes the Dow Jones Industrial Average can move back to new highs, or maybe it was the S&P 500, but can we move back to new highs without support from the transport? So this is a 10-year weekly chart. On the top, you've got the Dow Jones Industrial Average, and on the bottom, you've got the Dow Jones Transportation Average. And so if you look back to 2012, the blue dotted vertical line shows you that the Dow Jones Industrial Average was breaking out to a new high in 2012. But when we look down here, the transports were not. And in fact, over the next year, transports struggled, and so did the Dow. But as soon as the transports broke out in 2013, then we saw a big rally in the Dow and in transports. And then we did the same thing over again back in 2016, where the Dow broke out above those prior highs, and transports were nowhere near a breakout. And for the next several months, the Dow really struggled to move higher until transports rallied and got their breakout. And then once that happened, we had another huge rally. So I'm looking at it now, and the Dow just made another all-time high just a few weeks ago. And transports, like you mentioned, we've been going down for the last year. I mean, it's been since almost last summer since we've seen a high in the transport. So I guess that's the reason for the poll question. Can we go higher in the Dow Jones, in your opinion, without the transports coming up and confirming? And what do you make of this chart, if anything?
Well, of course it can happen, Tom. We've seen it happen. It happened just a month ago. The Dow hit a record high. But it's just not a good combination. Bear in mind we're, 11 years into this bull market, or the 10th year. It's the longest bull market in history, the longest economic expansion in history. So, you begin to look for trouble signs, and this is certainly one of them. The Dow transports have not confirmed the move into new highs, not to mention the 6 sectors that I showed you just a few minutes ago. So the fact that, and by the way, the groups that are in this are very economically sensitive, like the rails, the truckers, delivery services. Remember, UPS collapsed. UPS collapsed about a month ago. These are very economically sensitive stocks. they also tell us something about the global economy. So the fact that, let's put it this way, it's not a good thing when the transports are lagging this far behind. I would feel a lot better if the transportation stocks started to break through some overhead resistance. It looked like we were trying to do it about a month ago, but it didn't last. And also, I'll just kick in, I would also like to see the transports start to outperform the utilities. That would be another good sign.
Absolutely. I got maybe one quick question before we wrap up with you, John. The first one I think I can probably answer for you. There was a question, if the Fed goes to zero rates and the economy and markets continue to fall, then what do they do? And I think you said
zero rates.
What do they do? That's a really good question, right?
What do they do? What's the next plan? What's the plan for the next downturn? Well, look, we have negative rates in Japan for 3 years. Nothing's happened there. We've had negative rates in Europe for almost 2 years, 3 years. Nothing's happened there. So why that isn't that the definition of insanity, to keep doing the same thing over and over again? I'm not calling anybody insane, but I'm simply saying I understand why they're doing it, because it's the only thing they know how to do, but it doesn't seem to be working. And I'm afraid we may be forced to go along that same path. That may not be terrible for now, but the other thing that bothers me, they said the Fed's going to have to ease because things are looking a lot worse. Well, that's not very encouraging. Yeah. They're being forced to ease because things are weakening. Well, that doesn't make me feel good.
Yeah. All right. Well, I tell you what, it was great having you on here. It's always great to have you on here, John, especially when the market's so trying, with all the difficulties that we've been having to sustain our moves to the upside. Great to have your wisdom here on the show on Market Watchers Live, and really appreciate you stopping by.
Thanks, Tom. Thanks for inviting me.
Awesome.
Excellent.
And you too, Erin. Thanks for all the work.
Oh, you're very welcome.
All right. Well, we are down to about 10, 12 minutes, and we got to 10 and 10. So I'm going to be put to the test here, Erin.
No problem. I've actually been collecting them in the background. So let's go ahead and start with Bitcoin, GBTC.
GBTC. All right. Let's pull it up, take a look. All right. Well, don't really need it there. Let's go over here and don't need that relative chart. Okay. I think we're just consolidating after an uptrend. I'm not going to say whether or not I believe in Bitcoin. Technical analysts don't really look at that. We're looking at the price action. I see an uptrend. I see sideways consolidation, and it's wild. I mean, there's a lot of volatility here, but 12 to 17 is a big trading range right now on GBTC. A breakout would be bullish. A breakdown would be bearish.
All right. The next one is the most popular in the chat room. We actually have two, and that is the SOX, SOXX.
All right. SOXX. Well, I mean, it's a volatile group. We did put in a higher high here versus this high. So technically, as long as we put in a higher low, which we have so far, then I'm okay because we've got an uptrend established here. I think I would be watching the recent low that was just set. As long as we hold this low right here, I'm going to be pretty good with semiconductors, because I do believe we have an uptrend. I think if we go back down to those lows and fail to hold them, I think it does open up some additional movement to the downside. And this is a group that can be very volatile. So I would just want to make sure that I keep my stops in play in this group.
All right. Excellent. The other one that was most popular was gold miners, GDX.
Yeah, I'm not a huge fan of gold and the gold miners, and I know lately gold has certainly been doing much better. But I still think in time the stock market goes higher, and anytime the stock market is going higher, gold usually takes a back seat along with the miners. So I'm going to say that I'm okay with the chart short term, but given my longer term outlook, I don't want to lose any support level. So I would simply say here you've got price support that's been holding around 28.25. And if you wanted to give it just a little bit more room, I don't really want to see another violation of that 20-day moving average. So I would just keep a tight stop. I think the group looks fine right now in the near term. I don't trust this group longer term.
All right. How about Cisco?
Yeah, Cisco had gotten a little oversold recently on the selling. And I think it's coming back up right where it needed to. I know John alluded to a number of different areas of the market that held on to key support levels. I would certainly throw Cisco as an individual stock doing exactly the same thing. Here we had a beautiful move, came back down to 51, held again in June, went back up, put in a new high. So when I see a new high, I do not want to see a new low. So I really think it's important that 51 holds, and so far it has.
Okay, next up is going to be PayPal.
I haven't looked at this one recently, but I can just tell you I don't like the relative weakness that we had seen. Let's see if it's gotten any better. Yeah, I mean, look at the volume here. I'm going to go into a relative chart here. I just think that this is a stock that broke recent support. Volume has picked up. Look at the relative weakness. Even with the market bouncing, this is actually moving to a new relative low to its peer group and to the S&P 500, or getting close to another low. I just think things have turned here, and I'm not interested in the stock right now. I mean, maybe things will improve later, but higher highs, here was a key low, another high, and when we came back down, we went below it. So I think it's beginning to give this look of of rolling over and downtrending. So I think that 20-day, that declining 20-day moving average, if I was in it and it gets up there, I'd sell and look for something else personally.
All right. And what do you think of this semiconductor, MTSI, MACOM?
Yeah, this was a scooter mover not too long ago. I'm pretty sure MTSI, and I pointed out when the scooter broke out, I was probably back in here. I don't really remember exactly when, but it's been 2 or 3 weeks, I would say. Good volume trends coming in, and look at the relative strength here. I mean, this is definitely a stock that is strengthening versus its peers. Volume trends are good. So yeah, I mean, as long as this stock continues to show relative strength and continues to bounce off of a key moving average like this at the 20-day moving average, I have no problems whatsoever. I think it looks good.
All right. Let's take a peek at a newer stock, CrowdStrike Holdings, CRWD.
All right, CRWD. Not a whole lot of history here. So I think what I would just say is right now it's probably trapped a little bit. In the short term, it did establish a recent high, which we can annotate right there. And then to the downside, after the big gap up right here, we gapped up to over 85. We came back down and we got to about 81. All of a sudden, the buyers came back in. So I would be looking at that level and maybe that prior high, the 79 to 81 area, I think is going to be really important to the downside. Obviously, breaking above 95 is what you want to see, and I would want to see some volume come in with that as well.
All righty. Next one is Constellation Brands, STZ.
All right, STZ. Constellation Brands. Distillers, okay. Yeah, I mean, I'm looking at, I just don't see it here for me. I'm looking at the longer term relative weakness in the stock. And so I'm going to go down here. You can see the top was made almost a year ago in terms of relative strength. And that's versus its peers. And then this is versus the S&P 500. It's hard to outperform the S&P 500 when you're not really getting a whole lot of relative strength. I'm not really seeing huge volume other than this gap up, and that was with a filled candle. I just see too many areas, pockets of weakness here on this chart. I personally would look for something else.
All righty, let's see. How about Nokia? We only have 2 more.
All right, NOK. Huge gap up, came down, held the 20-day moving average, started to show relative strength, and actually we've been holding it. Even though we've come down, we're actually holding on to relative strength versus telecom equipment and versus the S&P 500. So this is one I could be okay taking a shot with. I mean, it's not a great longer-term play, but it's starting to show relative strength. So I would simply just watch that 50-day moving average and the bottom of gap support right near 510. I think this one's got a really good chance to go back up to that 570 area.
All right. And our very last one is a QD, and that is Quidian.
Yeah, I'm going to let you go with that. I don't really know. Yeah, I think a really nice looking chart here. I would maybe just simply wait for this breakout, but I'm seeing an ascending triangle. So if you connect the recent highs right there, and then draw under those rising lows. This is a bullish continuation pattern. So I'm right there through here. I think you've got a really nice ascending triangle, great volume trends, really nice relative strength. The only problem I see here is that you're right up against resistance. So I wouldn't initiate a position here. I'd either wait maybe to come back down closer to this trend line, or I'd get that high volume confirmation on a breakout. But I do like the looks of this chart. I like the pattern it's in. I think this is a keeper, one to keep an eye on for sure.
All right. And there you go. That is the 10 in 10. You did really well today. You just raced right on through. All right. So there are the symbols. If you wanted to go back and take a look at those, you can just scrub back on our video player right now.
Yeah, and then I think it's time maybe to pull up that poll, because I am interested to see what everyone else thinks. We talked with John Murphy a little bit about transports, and he certainly would like to see the transports come back up, although he did say that it wasn't necessary for them to come back up in order to support a breakout. But it looks like the audience is saying that the S&P 500 probably won't move up to all-time highs without support. 64% don't think that the S&P can move up to all-time highs without support from transports. What do you think, Erin?
I went ahead with the Dow Theory and did say, no, I think it needs help from transports, but I also think it needs help from the small caps and the mid caps. There's a lot of headwinds right now that are causing issues, I would say, for moving up to those all-time highs. I think that it will need some help.
Yeah, I agree with John that, we could move to highs without transports breaking out. But I think to sustain a move to the upside, to really have an uptrend in play and really get going, I think you got to have the support from the transports. I mean, if you think about the strength in our economy and what that would translate into, it should translate into transportation stocks doing well, because if our economy is strengthening, we should be shipping more goods. The truckers should be doing better. The railroad should be doing better. Airlines are a little bit more volatile, and I don't pay as close attention to those as I do railroads and truckers. But to me, there's no reason for railroads and truckers to go up unless they're going to ship more goods. And if they're going to be shipping more goods, that generally coincides with a pretty good stock market. So Dow Theory has been around a long time, longer than me. And I think that it is, I think there's a lot to it. I really would like to see the transports support a breakout to the upside. So I'm going to go no as well. Even though we could get to a new high, I just don't think it's sustainable unless we get transports going.
Now, I have to say, like I said, and I think there's a bit more under the surface as well that we need to look at. So, all-time highs, I'm with John. I think short term, we're looking pretty good as far as a little bit of a bounce here. Past that, we do need to see some of these sectors that aren't defensive start to see some work being done there.
Yeah, well, you can look at the current market today, and I'll tell you, since about noon yesterday, this has been a straight up move. The Dow Jones Industrial, this isn't a gap up or a gap down where I think there's a lot of manipulation that takes place. This is concerted buying from midday yesterday till now. We have gone up on the Dow more than 600 points. And anybody who's wanted to sell into this rally, we've got willing buyers that just keep driving prices higher. This has been a pretty solid advance. And as I mentioned earlier, we do have a lot of our aggressive areas of the market leading it. So it looks pretty good to me. Any final thoughts? You got about 10 seconds.
Oh, final thoughts. Yesterday, Carl asked about whether we were hitting a bottom. I was in the minority with yes. So I'm feeling pretty good about that.
Awesome call. All right. I want to thank all of you for being with us today. Special shout out to John Murphy. Always a pleasure to have him aboard here on Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, noon to 1 p.m. Have a great Thursday afternoon. See you tomorrow. Happy trading.